Hey YouTube, recently in my October update I mentioned how I sold a put option for the first time this year, and so in this video I want to go into detail as to what that put option was and what the underlying stock was. Put options are a good way to buy a stock. Even Warren Buffett does it. And let's learn a little bit more about a put option and how we can make some money off it. So the put option I sold was for Upwork.com, and I sold this on 30th of September. I sold one put option, which is why you see -1 here, and I sold it with an expiry date of 17 Jan 2020, and I sold it at the strike price of $12.50, and I got a premium of about $110, and you can see that $110 was deposited into my account on 30th. So when I sold the put option, I believe the price of Upwork.com was about $13.50, and so the closer your price is to the strike price, the more premium you get. I'm going to play a video now explaining what put options are, in case you do not know. Before I play that video, another point to remember is that one put option is for 100 shares. So that is why you have to times the price you see here by 100, which is why I said the premium was $110.
Hello and welcome. In this video, I show an example of selling a put option to buy stock. For this example, I will use SOV, the silver ETF. At the time of making this video, SOV is currently trading at $18.62 per share. Let's say that a trader wants to buy 1,000 shares of SOV to hold long term. However, this trader only wants to buy SOV if the price of SOV drops to $18 per share, which is the price that he feels is a good price to buy and hold at. One choice would be for the trader to place a limit order for $18 and leave it open. If SOV drops to $18 or below, the order is executed and the trader buys the 1,000 shares for $18 a share as he wanted to do. Another choice would be for the trader to sell 10 $18 put options that expire in 1 month. By doing so, he is agreeing to buy 1,000 shares of SOV from the buyer of the options for $18 per share if SOV should drop to $18 or below. The buyer of the options pays an upfront cost to buy the options called a premium. In this case, the premium is 33 cents a share or $330 total. The premium varies from stock to stock depending mostly on the stock's volatility. Now let's compare the two choices. Trader A places an open limit order to buy 1,000 shares of SOV for $18, and Trader B sells 10 $18 put options on SOV. Let's say SOV does not drop to $18 or below over the next month. Trader A sits there with his open $18 limit order and nothing happens. However, Trader B sold 10 $18 put options and was paid $330 to do this. Because SOV does not drop to $18 or below, the put options expire worthless and unused, so Trader B simply keeps the $330. For Trader A, nothing has happened the entire month except that he had to leave $18,000 sitting unused in his account waiting for the price of SOV to drop. For Trader B, things are a bit different. He sold 10 $18 put options and was paid $330 to do it. He also has $18,000 sitting in an account as well, but he has made $330 with it, which is almost a 2% return in a month on his $18,000. His money is also sitting unused, waiting to buy the same stock Trader A is waiting to buy. However, he has made a 2% return in a month on that $18,000. Let's say instead that SOV drops to $17.75 a share. The limit order for Trader A is executed and he buys 1,000 shares of SOV for $18 a share. The put options for Trader B are executed and he is assigned 1,000 shares of SOV for $18 a share, which is a fancy way of saying that he buys 1,000 shares of SOV for $18 a share from the guy he sold the options to. Now let's compare. It is important to note here that I am leaving off commissions for simplicity. Trader A lets $18,000 sit in an account, then bought the stock for $18,000. With the current price of $17.75 per share, he is down $250. Trader B sold 10 put options and was paid in this example a total of $330 for this. He also bought the stock for $18 a share, but he was paid a total of 33 cents a share up front, so his total net cost is $17.67 per share. He is up $80, while Trader A is down $250. Remember that both traders wanted to buy and hold the stock for $18 per share, and both traders did that. If the stock had never gone below $18 a share, Trader B could keep selling put options each month making money, while Trader A's money just sits in his account unused. Let's say that SOV drops way down in price. Both traders were going to buy SOV at $18 anyways, so both traders are in the same situation. Only Trader B was paid money up front selling puts, so his losses are less than Trader A. Where Trader is going to buy a stock at a set price below the current price, using a put option may be a method to consider. However, it is important to also note that one should only sell put options in this manner if they actually want to purchase the stock.
So now you understand how a put option works. So the reason I like Upwork is because it has a low share price. So I can use a put option to buy it. If it was something like Facebook or Amazon, I wouldn't be able to use a put option because one put option, like I mentioned, has 100 shares, and that would be too much of a risk for me. But since there are only 100 shares for Upwork, so if I had to buy 100 shares at the strike price of $12.50, that would be $1,250. And in fact, I would be happy to buy Upwork.com at that price. So let's examine some of the worst case scenarios that could happen. So let's say the price of Upwork.com falls to $11.50. That would be my break-even position, because a fall of $1 would be a loss of $100, and I got a premium of $110. So around $11.50 would be my break-even position. If it falls further, let's say $10.50, then I will suffer a loss of $400, including the premium that I had gained. But I mean, I would be happy, like I mentioned, to buy Upwork at $12.50 because I think it is a good price. In fact, as I mentioned in the previous video, I bought shares of Upwork at about $3.80 in the past. There is another scenario that could play out as well. That is if the shares are assigned. So let's say the price of Upwork.com falls to $12.50 and the holder of the put option decides to assign the shares. Currently, I do not have $1,250 in my account. I only have $193. So what could happen is, I understand from the broker, is that if I do not have the cash for the assignment, the broker will close the trade. If the broker closes the trade, I could have a loss on this position. As you can see right here, currently the market value of this put option is about $82.50. So if the broker were to close it today, I would still make a profit because I got $110, right? So just to play it safe, I plan to deposit at least $1,250 to cover the possibility of an assignment of the shares. I think that would be better because I would not want the broker to close the trade because of a sudden dip in the price of Upwork. So if Upwork continues to fall, I might sell another 1 or 2 put options on Upwork. I don't want to have my position level for Upwork at too high a level. Currently it's at about 1% of the portfolio, but I don't mind bringing it up to about 2 or 3 or even 4% at the right price. So I might be able to sell another 1 or 2 contracts on Upwork if Upwork continues to fall. And I think that is a better way of buying the stock at good prices. So in my previous video on why I bought Upwork, I gave you a few reasons why I like Upwork. So this is another reason why I like Upwork, because I can sell put options on it. And I'm going to let you listen to a few words from the CEO as well about Upwork.com.
The world's largest freelancing network, Upwork, has raised $187 million in its initial public offering. The platform, which connects freelancers with clients, was formed through the merger of competing companies, Elance and Odesk, in 2014. Now it boasts 375,000 freelancers working for almost 500,000 clients. Bloomberg's Alex Barinka caught up with CEO Stefan Casriel to talk about the IPO.
The specific segment of the freelance economy that we serve are people that tend to be highly skilled. 80% of the users on Upwork have a college degree, 34% have a postgraduate degree. So these are people that are truly doing this by choice. If they wanted a traditional W-2 job, they could easily get one. What they're getting through Upwork is they get more freedom. They choose to be their own boss. More flexibility. They can work from anywhere. They can work on the schedule that they choose. They essentially choose their clients. And on top of that, they typically make significantly more money than they would make through the local job market. So what we hear from freelancers time and time again is they would much rather take a higher pay and then choose their own benefits, as an example, than what would happen through a traditional employer. 50% of the freelancers, when we survey them, we ask a question, which is, how much money would a traditional employer have to pay you to convince you to take a full-time job with them? And literally 50% of the respondents will say no amount of money. So this is really something people do by choice as opposed to doing it by necessity.
So where does the growth come from then? You've got this new war chest, $187 million raised in your listing this week. Where are you going to put that money to work to continue expanding?
Yes, so we're going to continue to do what we've been doing, right, which is really trying to get more new clients signing up every single day, as well as getting the existing clients to spend more on the platform, including cross-selling clients from one category to the other. What we see a lot is clients start by, let's say, hiring developers on Upwork, and then we get them to realize that we also have designers on the platform, and then progressively one thing leads to another, and they start spending across the 70 categories on the site, which ultimately is all about creating more jobs on the platform, because that is what we need more of in order to fulfill the the need for work that freelancers have on the site.
Lastly, you did say that this is an increasingly competitive market. You have the likes of LinkedIn, you have Google, Facebook, and of course there's Amazon, who tends to make competitors shake in their boots. Who are you most worried about, and what are you doing to be sure that some of these big tech giants aren't taking share from you in what seems to be an attractive space for a lot of these tech companies?
Yeah, well, I think the reason why investors have been really interested in the company is because of the strength of the competitive moats in this business. This is not an overnight success. This company has been around through the predecessor companies that merged together for almost 20 years. It takes a long, long time to build the network effects that are necessary to do this at scale. But once you get the spin wheel going, it feeds itself. So today, 100% of freelancers who sign up on Upwork do so through word of mouth. 80% of the business on the buyer side also comes through free channels, including word of mouth. And so the spin wheel at some point starts to really accelerate, and that is, those network effects are one of the main sources of really strong competitive moats, and we think it's going to be really hard for others to imitate. Obviously, we continue to innovate a lot. We spend a lot of money on research and development. By the way, we use freelancers a lot. There's 1,500 people who work at Upwork. 1,100 of them are freelancers. So we're able to attract really, really top talent from around the world to innovate and continue to push forward as we build this freelance economy.
So I'm still learning more about Upwork.com. I like listening to the CEO. I think that's a good way to get a real insight into the company and about the prospects of the company. So that's a wrap for this video. Let me know what you thought about my decision to sell that put option. Did I identify all the risks properly? Let me know if you think it's a good or bad decision. I look forward to your feedback and comments, and I look forward to learning from you as much as I can as well. So thank you, and we'll see you in the next video.